Hey friends, welcome to this episode of the Cringe Post podcast. This is a bonus episode. My name's Britt. My co-host Donnie is out for today. So following in his footsteps of doing bonus episodes when I'm out, we're doing one when he's out. And today I thought we could talk about inflation, the Federal Reserve, interest rates, kind of all these nebulous terms that get thrown around, but I know at least for me, I didn't understand until I started studying business and economics. And in fact, the impetus for this podcast, I was talking with a friend of mine, very, very smart person, but not super smart in the financial ways or anything like that. And they were talking about like, well, can't they just print the money? If we need money, can't we just print it? And I realized right then, maybe there's a lack of understanding about some of these basic and fundamental economic concepts. And that's kind of what led to like, oh, well, we want to put this out there, right? We want to make some of these more complex things that typically get hidden behind jargon and PhDs and all this stuff, make it simple and easy for the common person who doesn't want to be nerdy and read a bunch of economics books, make it easily accessible to them. And so today I thought we'd talk about that sort of stuff, especially with the passage of the, quote, Inflation Reduction Act, unquote, which in fact does nothing to reduce inflation. So to begin kind of what our story and our journey through all this, I think it bears worth for us to talk about what is a bank and how does a bank work. Yes, a bank is a place where you go to store your money. And banks, the way they make money to pay for the place that they store your money, pay for the ATMs, pay for the tellers and all the people that organize and move money around. The way they pay for that is by lending the money that you store with them out to other people at interest, right? So 5, 6, 7, 10, 20% interest rate, depending on if you've got a credit card or if you've got a mortgage or some other type of loan. So in addition to this, traditionally, one of the benefits to you as someone who deposits money at a bank is that they will incentivize you by also sharing a portion of those profits or that interest with you based on how much money you have stored with them. So if you have an interest rate of 10% and you store $100 with them, they're going to give you $10 a year based on that. You're not going to find 10% interest anywhere, unfortunately. These banks, though, they serve a really important function for society. So traditionally, right, like without a bank, if you wanted to go, build a new app, or you wanted to go build a car or build a house or something like that, if you didn't have the capital stored up, if you didn't have the resources stored up, you didn't have $500,000 to go do this venture, you would have to wait until you had $500,000 stored up, and then you could go spend it all on this venture. Obviously, this makes everything really, really slow, gridlock, because then only people who are in their 40s or 50s and have stored up that capital themselves could ever actually make any change. Banks are awesome in that they take capital that is not being used, money that people have said, hey, I don't know what to do with this. I've saved it, but I don't know what to do with it, so I'm going to put it in the bank for safekeeping. You decide where to go put it to get the best return on it. Those banks are able to loan that money to those people so that innovation and growth and new things and services can be made as quickly as possible. And this is really, really awesome, right? And in a traditional free market, right, like you'd want to store money with a bank that is really, really, really wise in how it makes its lending decisions, because they are in fact lending out your money. And if they lose your money, then you are out of your money, right? The goal of the bank is to protect your money. And so in a free market society, you'd have banks that are more risky, like be able to take more risks, and then banks that are more risk adverse. So that kind of brings me to the incentives for both customers and banks and how these incentives drive different types of actions. And so customers, people that deposit money at banks, you want a safe place to store your money, first of all. And ideally, you want to store your money in such a way that your money works for you, so that you're able to partake in some of the interest that is generated from that. You also want the ability to easily access and withdraw that cash. So if I deposit money here in America and I fly over to Europe, One of the benefits of the bank that I bank with is that I can withdraw money at ATMs over there, or even if I'm on the other side of the country, or down the street or something, I don't have to go run to the bank to get the money. I can just go to an ATM and grab it. Likewise, I don't have to, if we were still in the gold standard, I don't have to haul a nice big gold brick across the ocean to be able to pay for things. Banks, on the other hand, they want to have as much money that you give them loaned out to people as possible. If they could, and they do, have $0 on hand at all times, because any money that is not being lent out is money that is not generating interest, not generating profits for them to operate and make more money. This incentive is directly opposed to your ability to withdraw money, right? So let's say that a bank was able to go and lend out all the money that they have, and I had, $2,000 deposited with them. And I wanted to go, I said, hey, I think it's time I want to go buy an Xbox. So I say, hey, I go to the bank, I wanted to, withdraw $600. And they say, hey, I'm so sorry. You can't withdraw it. We don't have any money on hand. Come back in 2 weeks when we get the payments for the loans that we've given out. That would be really a big bummer, right? Like I that is in direct opposition of my goals and what I want to have happen. And so I might take my money someplace else, right? If the bank wasn't giving me a really, really great interest rate, they weren't giving me a good return or whatever, I might be like, hey, this is enough for me to take my money someplace else. And other customers would probably as well, and that bank would fail. And so this brings us to the Federal Reserve and reserve requirements. And so something that can happen in societies is that banks will loan out too much money to people, and they'll loan out money to people that shouldn't have money loaned to them at all in the first place. We'll get to that more in a second. And when that happens, suddenly they don't have enough money to cover withdrawals, right? People panic, everyone goes, it's called a run on the banks, and people show up and they say, hey, I want to get the money that I deposited with you. And the bank will have to say, well, I'm sorry, we don't have any of that money on hand. And so the amount of money that a bank has on hand is called their reserve. And the Federal Reserve, it's a private and government entity, kind of a weird mix, set up to basically control our financial system through interest rates, through reserve requirements. And so one of the first tools that they have for that they enforce upon us and enforce upon banks is something called a reserve requirement. So in a normal free market society, banks would be able to set their own reserve requirements, and that would be a selling point to their customers. They'd say, hey, customer, you are a more conservative investor. We only loan to people that we know for sure are going to be able to pay us back. But because of that, and to get those people's business, we have to offer low interest rates and make money cheap. And so you're only going to get 1% back on your money, but you can rest assured that your money's safe with us, as opposed to, a bank that is a little bit more tolerant of risk, but they could maybe not guarantee, but they could say, hey, on average, we return 15% on your money. So that's, in a traditional society, that's how banks would set their reserve requirements, and they would be part of their selling points. The federal government comes in and says, no, banks, you don't get to do that. Customers, you don't get to decide who you bank with based on how they operate. All banks are going to have the same reserve requirements. So currently today, banks have a reserve requirement set by the Federal Reserve of 10%. So this means that if, let's say, a bank has $1 billion on hand that's been deposited with them, not on hand, but that's been deposited with them, then they are required to have $100 million at any given moment on hand. And if they don't, they face really stiff penalties and potentially could no longer be a bank. So banks are technically not supposed to lend out beneath that reserve requirement. If they dip to $90 million, they better really, really fastly get $10 million into their account so that they can meet those reserve requirements. Usually it needs to be done, if it happens in the middle of the night, it needs to happen by the next morning. So now this is where it runs into what we talked about earlier, the bank's incentives, which is they want to loan out as much money as possible because any money that they don't have lent out is money that is not making money for them. And so a lot of times, believe it or not, banks will mismanage money, or they will purposely choose to lend out more money than they can have to fulfill the reserve requirement. And so when this happens, the bank will then need to go borrow money from another bank, or they'll need to borrow money from the Federal Reserve so that they can fulfill that reserve requirement. And Brings us to interest rates. So you'll hear a lot of the time, people talk about, well, the interest rate, they're raising interest rates or they're lowering interest rates. And what people are talking about when they say that is the Fed funds rate. And so the Federal Reserve not only sets the reserve requirement for banks, but they also set the interest rate at which banks can loan to other banks at. So I think right now the Fed funds rate is around 2.5% or 3% or something like that. And so basically, let's say the bank with $1 billion in deposits needs to borrow $10 million to fulfill the reserve requirement. They can go to any bank and say, "Hey, please lend me $10 million," and then that bank that wants to lend the money can lend it to them at 3%. And so, like I was talking about, banks are incentivized to lend out as much money as possible. If the Fed funds rate is 3%, hypothetically, and in reality, a lot of times what they'll do is they will actually lend out more money. They'll lend out all the way to zero on their balance sheet, or not their balance sheet, but in their deposits. They'll lend out to zero, lend out all the money they've got, and then they'll borrow $100 million at 3%. But it's okay because then they're charging the people they lend the money out to, 5, 6, 7%, and then they're only giving you, who has, savings, a really, really small percentage and all that stuff. So it's kind of a way that they game the system. And this gaming of the system, this poor structure, and this thing that is unsustainable is a result of the Federal Reserve existing and being able to set interest rates one way or the other. Because if the market set interest rates, you wouldn't be able to do this, right? No one in their right mind would go loan money to a bank that is lending out all of their money at all times, because you would never be able to. You would be really worried about your money being able to be returned to you. But because of the Federal Reserve and their ability to print money, which we're going to get to here in a second, they feel really, really comfortable about doing this. So let's see where we're going to talk about it. Oh, okay. So let's talk about the relationship between interest and spending. So along with you hearing people say, "Oh, well, interest rates are going up or they're going down," you also hear talk about we want to generate and stimulate the economy by lowering interest rates. And so how does that relate to the interest rate and how you spend money? And the real reason, the real function of the tool of controlling interest rates that the Federal Reserve has is to reward or penalize spending. And saving. So an example of this. So let's say you're storing your money at a bank and you have an interest rate of 10%. If you worked 15 years and you had $100,000 stored at that bank, that means basically for no work at all, you're receiving $10,000 a year in interest just for letting your money sit and be loaned out. The interest rate's really high. Will probably make you think twice about going and buying a $100,000 Corvette with that $100,000, because if you leave that $100,000 in there at 10% interest each year, maybe in another 5 to 8 years, you'll have so much capital built up that you'll actually be able to go buy that Corvette without even touching the principal. You'll just be able to buy the Corvette with the interest payment. So you are disincentivized from spending money because the interest rate is so high. And you are in turn incentivized to keep that money sitting in the bank and being lent out and stored there. You don't want to spend it. Now, on the opposite end of it, let's say that the interest rate is 0.1%, right? So for $100,000 being stored, you're paid out $100 in interest each year. It's going to be a lot easier under those circumstances to justify, well, man, I could keep my money in the bank now, save it, have $100,000 sitting there, and in 10 years I'll have $1,000 more. Or I could just go and buy a Corvette and have a happy 10 years, driving around, doing all that stuff. And so that's how the interest rate drives or doesn't drive spending. And so this is also tied to the fact that the government wants to incentivize spending, because when you spend money, when the velocity of money is high, it's moving around a lot, they're able to tax it, right? If your money is not being spent, if it's not being used, it's not being paid in salaries, or it's not being purchased for goods with sales tax, the government doesn't have any access to that. So they really, really want you to be spending money, and that's why they are incentivized to keep interest rates low. So on top of that too, right? It feels good to spend money, right? It feels good to be able to go buy that Corvette or buy those things that you want right away, as opposed to having to save up and wait for it. And when left to the free market and people are allowed to fail or swim on their own, this is a great system, right? Because winners are rewarded and get to continue on, and losers are taken out, and bad actors are taken out. And this is really, really present in 2008. So 2008, you see the Fed funds rate, basically around 0%, right? They had taken interest rates, made it so easy to borrow money. Money was so cheap. And so that in turn meant that monthly payments, if you got a $300,000 loan for a house, because interest rates were so low, people now had access to more and more money at less and less cost. And so prices for houses inevitably kept going up, right? On top of that, because the Federal Reserve and the Fed was able to basically guarantee loans, right? Like if a loan went bad, the Fed said, oh, well, we'll buy it from you. Banks really lightened up on their requirements for loaning to people. So if you've ever watched the movie The Big Short, you'll remember like people that had no business borrowing money for one house, let alone three, were able to get loans for these houses. They had no way of paying this money back. But the banks were incentivized because they want to have as much money lent out as possible. And if there's no risk to them lending that money to these people, why not do it? And so they lent all this money to all these different people, called it great. The problem is that eventually the bill comes due, and these people that couldn't afford houses eventually stop making their payments, right? So month one, at this bank, let's say you have $1 billion lent out as a bank, and you have that reserve requirement we talked about earlier. 1 month, $50 million in expected interest payments don't come in because you lent to people that shouldn't have money lent to them. And you're like, oh my gosh, like what are we going to do? Like, oh, no matter. I'm just going to go borrow money from another bank to make up the shortfall. The problem is that other bank was doing the exact same thing you were doing, and they're in the exact same position. So they don't have any cash either on hand. And you can see how this is what happens when a bubble pops, right? Suddenly the reality sets in. Everyone realizes we lent money to people that can't pay it back. And now the people and the customers that have deposited and trusted us with their money, we no longer have it. So what happened in 2008 is exactly that, right? Like this bubble popped. George W. Bush was afraid of a run on the banks, was very, very scared, as well as the political outcomes of him overseeing this potentially disastrous, I mean, not even potentially, it was disastrous scenario. And so he said, you know what? We're going to print $800 billion. We're not going to let the banks go under. We're going to print $800 billion, and all these different banks are going to get a windfall. We're just going to give it to them to keep them at the reserve requirements so that people don't have a run on the banks and people can still spend money and all that stuff. So the Federal Reserve printed this money. And when I say printed, it's not like they have like a printing machine or a printing press and they said, okay, fire it up. And, in 5 days, we'll have $800 billion or something like that. No, they literally just go into a computer and they say, hey, bank, like your portion of this $800 billion is, $500 million. Type, enter, $500 million shows up in that bank's electronic system. There's no actual money being printed. It's being printed out of thin air, literally. It's just fake. It's not real. So they would do that, and then the banks would be like, okay, sweet. We just got all this money, right? Now we have the ability to have reserve requirements and all this stuff. We're not going under. And the way that they, and by the way, this is a tax on you. I'll talk about that here in a minute. But then these banks decided, okay, well, great. We got a windfall of $800 billion. Let's actually just pay our executives bonuses. Let's foreclose on all these houses that people that we lent to that can't afford it. And then we'll sell these houses to, other people. So the banks came out on top. They not only didn't reap the rewards of, or not rewards, they didn't reap the consequences of their mismanagement. They actually gained because they got the $800 billion and they also got the assets that they loaned on. The normal people like you and I, we lost out, right? Because of their bad management practices. Our tax dollars went to fund them. Future tax dollars through inflation went to fund them. And then our friends and family and people that we know lost jobs and lost their houses and couldn't afford it. So that is the evil at the core of people regulating, having too big to fail banks. And you see a lot of these people, will talk about like, well, that's just an instance we need to regulate these banks more. It's like, no, these banks needed to be allowed to fail or succeed on their own. These banks should have, the banks that weren't doing these practices would have survived, and then they would have doubled down upon their good practices and kept going on and being, good stewards of the money that's being deposited with them. And then the bad actors that were lending to people that they shouldn't have been lending to, not keeping their reserve requirements, not actually being prudent in how they manage other people's money, would go under and be wiped away and gobbled up by the good banks and good actors in the market. Because of this, we have shown, the government has signaled to banks that like, hey, you can act in the worst possible way, and there's not going to be any consequences for you. In fact, you actually might come out ahead if you act that way. So why not act in such and such a way? So in a free market, that wouldn't happen, right? And coincidentally, we're having that same scenario today, right? People are able to get money really, really easily, loan to them because it feels good to spend. And that's why we have houses that were worth, $100,000 in the 90s. They're now selling for $1.5 million today. The prices have gone absolutely bonkers and gone crazy. And you think about the fact that like, okay, in 2008, we printed $800 billion for this. In 2020 and 2021, we printed $6 trillion for this. And you can only imagine what effect that's going to have on inflation, and we're seeing it today. The other aspect that I also want to talk about is quantitative easing, or QE. So you might see this phrase thrown around. So with stocks, in the stock market, a lot of times what will drive up? Oh, it's not a lot of times. All the time, a price for a stock will go up when people are buying it. The price will go down when people are selling it, depending on where the buying or selling pressure is. And so quantitative easing is where the Federal Reserve will actually print money to go buy stocks and assets from the private market. And this is in an effort to shore up prices and stabilize these prices. They generate fake demand for different stocks. And so during a time of crisis, people a lot of times will want to get out of stocks and take their money and put it into more tangible things like food or ammo or paying off their mortgage on their house or different things like that, which will obviously drive down stock prices. And then when stock prices go down, pension funds and retirement funds go down, and everyone becomes really, really unhappy. And so the Federal Reserve's tool for doing that is quantitative easing, where they buy up these different stocks and all that stuff. If you've listened to our show, you realize that like this is obviously a really, really bad scenario, because who is managing that actual purchasing, right? They're just purchasing not because there's actual value in the stocks that they're buying, that's the whole function of the stock market, is to say, hey, this company is doing great things. We need to fund them. We need to value what they're doing really, really highly. So let's pile in there and give them a lot of money because we believe they're going to do a lot of great things with that. The Fed is not buying these assets because they think there's value. They're buying it to try and keep and prop the price up, which is obviously very, very unsustainable. So going back to my friend's question about like, well, why can't we just print money? Like, why does that hurt us? And I kind of want to use a scenario, and I used an Xbox earlier, so I'll use the video game scenario again here. So imagine you are, in a room with 100 other people, and someone comes in and says, hey, here's $100 each. And over here on a table, we've got 100 Game Boys, and we've got, a bunch of different Game Boy games. You can buy the Game Boy for $25, and you can buy the games at $5 a piece or whatever. Also know that, a Nintendo Switch is coming out in a couple hours, and the Nintendo Switch is going to probably be, $70 or $80. So make your purchasing decisions based on that knowledge, because if you want a Nintendo Switch, maybe you should save your money instead of spending it right now. So you can buy the Switch later. So in this scenario, let's say 90% of the folks say, well, you know what? I just want to enjoy a Game Boy today, right now. So they spend most of their money. Maybe they have $10 left after they buy the Game Boy and all the games and all that stuff. And they're playing and they're having a great time. And then the 10% of people that want to buy the Nintendo Switch, they say, hey, we're not going to do any of that stuff. We're going to save our money. Let's say they even save 100% of their money. They save all $100. They keep it on hand. A couple hours go by, the Nintendo Switch comes out, and the guy says, "Hey, there's only 15 Nintendo Switches, and they cost $80 a piece." And so all the people that saved, the 10% of people that saved, think, awesome, like I saved $100, and there's a limited amount of Nintendo Switches, so I'm pretty much guaranteed able to buy one, right? Like there's 10 of us, and there's 15 Switches, and the 10 of us are the only ones that actually have enough money to go buy that Switch. So yay, awesome, we're going to be able to buy the thing we wanted to, and I saved my money, and I made a choice, to go get that Switch. Suddenly, though, the 90% of people that spent their money on things right away start saying, no, this isn't fair. Like we want to be able to buy a Switch as well. And so they say we need to have some sort of stimulus. And so this person that is giving us all these video games and selling them, not even selling them, but some benevolent entity in this scenario says, okay, no problem. Like we're just going to print $400. So here, everyone have $400. So everyone gets $400, including the people that saved $100, saved all of their value. And so now you've got a room full, 100 people with $400 each. Some of them have $500 because they saved. And now there's 15 Switches left and everyone wants one. And it's whoever's able to pay the most for the Switch is the one that gets it. And so now instead of having to, instead of paying $100 for the Switch, the people that saved, they can still get the Switch, but they're going to have to spend $480, $500, at least to buy that Switch. And that's how you get inflation, right? There's more money chasing less and less goods. And the people that saved, the savings that they did, that $100 that you saved in that scenario, is basically, it makes the difference in you being able to buy the Switch. But the value of that is basically destroyed, right? It's worth 1/5 of what it was before because now everyone else has the same amount of money. And your value has gone down. And so that's what's happening when people print money is they are, I was playing, keep with the video game scenario, I was playing Red Dead Redemption over Christmas break. And the game is set, I think it's like 1900s or 1910 or something like that. And you could go buy a steak dinner for 45 cents and you can go buy like a house in it for $5,000 or something like that. And I remember during that December, my wife and I were looking for houses to buy, and I saw a house on Zillow, and it was built in 1912, so a few years after Red Dead Redemption. But it was built in 1912, and it was selling for $1.1 million. So the same house that you could have bought for $5,000, 110 years ago, is now selling for $1.1 million. And so that's kind of to illustrate how that works, right? Like if you'd saved $5,000 back in 1900 and did nothing with it, even though you could buy a house with $5,000 back in 1900, that $5,000 that you saved is now worth nothing today. So you're penalized for saving money, penalized for planning for the future. And it's all in an effort to, one, politically make people feel good, two, extract as much tax dollars out of you as possible. And people don't realize that when they're talking about printing money, even though it doesn't feel like it, it's a tax on your future dollar value. It's a really, really steep tax. It's a tax on your dollar value. It's a tax on your children's dollar value and on your grandchildren's dollar value. And you just don't feel it right now. But you might as well consider it. It's like in 100 years, the dollar you make today is going to be worth, 90% less than what it's worth today. And the government has borrowed on your behalf for that. And so anyways, that's, I think, where we'll leave it today. If you liked anything I was talking about, or you have any points or want to talk about it more, please be sure to DM us, like, share, and subscribe. We are on cringepost.com and cringepostpod at all social media handles. And hopefully we have Donnie back here in a few days. And until then, I'll catch you then.